What we're actually seeing is probably the third supply shock in as many years. And what we're really thinking about here is a scenario where you're going to get inflation spiking in the near term, but ultimately it becomes quite constricting on the economy. So financial conditions tighten, and therefore you end up in a classic stagflation scenario.
Very simple question, hopefully. The global bond market, is it facing a crisis of confidence?
Well, there's certainly a lot of pressure on bond yields playing out across many jurisdictions at the moment, but it's largely a policy rate expectation story at this point, driven off the back of the Iran conflict and the spike we're seeing in oil prices, which is flowing through to higher inflation risks.
Okay, well, with those higher inflation risks, are we greatly underpricing or under forecasting just how high both domestic and global interest rates can go?
It's interesting question, because what we're actually seeing is probably the third supply shock in as many years. And what we're really thinking about here is a scenario where you're going to get inflation spiking in the near term, but ultimately it becomes quite constricting on the economy. So financial conditions tighten, and therefore you end up in a classic stagflation scenario.
The bond market's pricing that in now, surely.
No, they're not.
Okay.
It's really, you should think of it as really a sort of a two-step phase. The market is grappling with the inflation risks at this point, and at some point when rates continue to percolate upwards, as we're seeing currently across many countries, that the financial conditions tighten so much that it chokes off growth. That's really a consideration for the next 3 to 6 months, I would say. It really depends on how fast the rates adjust here. It's not just the level of rates that matters, it's actually the speed, because financial conditions are already tightening by stealth.
So then what would be a catalyst for a dislocation in the bond market? Because bond yields are rising, there's no question about that. We're seeing it in the UK, Japan and the United States. What would be a catalyst for, and I hate to always use the word panic, but what would be a catalyst for a dislocation in the markets where things get out of hand?
Well, I think the front and centre would be the way the Fed reacts, particularly with the upcoming meeting. Only up until recently, they were talking about Fed, rate cuts. So the FOMC projected Fed funds were all taken, basically suggesting that rates are going to go lower at a time when clearly there were inflation risks. And let's not forget the AI boom that's also pushing up productivity potentially. So you could argue that even at the starting point, the Fed's policy rate was way too accommodative. And certainly I would be arguing that.
Are you concerned about the Japanese carry trade? And I'll just throw in as well, there's a potential for Keir Starmer to lose the prime ministership in Britain, and there are fiscal consequences for that. What are you looking at? Are you looking at Japan or the UK?
Yeah, many cross currents, as you're currently alluding to. So Japan is probably front and centre for mine, primarily because their fiscal position is clearly unsustainable, and it's clearly putting a lot of pressure on the yen. And it's a question of how many reserves they can keep on selling. Each time they hit the currency markets, US Treasury yields back up. So this becomes a bit of a doom loop. And then the other thing to consider here is that the Japanese investor domiciled in Japan may look to repatriate some of that money that's been basically invested across all markets. So as they pull funds back into Japan, because now ostensibly they're getting a higher hedged return, that could also put sort of upward pressure on yields in other jurisdictions.
Tano Pelosi, just two really brief questions to finish off with. The Australian 10-year government bond yield is well above 5% at the moment, comfortably above 5%. What does that mean for the government, and what does it mean for households?
Well, it's potentially problematic, particularly if you go back to the budget and have a look at what the key element of that savings is in the outer years. It's the NDIS savings that they've purported that they're going to sort of address. And there's a lot of execution risk around that. If they don't pull that off, it has obvious sort of spillover effects to the bond supply issue. So if we see a lot more bond supply, that's going to continue to put upward pressure on long bond yields. But I would say, just very quickly, Australia already had its mini sort of bond rout last year when our conditions were too accommodative for the inflation risk that we were facing.
Tano Pelosi, without speaking in hyperbole, are we seeing the kind of bond market that could lead to a share market crash?
Well, this is the other risk. So when you get quite a rapid rise in yields, it's tantamount to a shock to equities, particularly through the discount rate. So effectively what you're getting is a valuation impact here. So if this continues, that is problematic for equities, and particularly growth stocks.
Risk of a crash?
Well, I wouldn't put it at that point. I would say to be alert and not alarmed. The central banks have tools in their toolkit that they can address these issues. But ultimately, it comes back to the policy stance of central banks, and particularly the Fed, taking a more sort of aggressive stance, facing into inflation risks. And if they don't do that, particularly with the upcoming July meeting or June meeting, that would be somewhat problematic for markets in general.
Problematic indeed. Tano Pelosi, it's been terrific to get your insights. Thank you for joining the business.
It's a pleasure.